This is chapter 6, where we're going to discuss capital budgeting. And we're going to start with a discussion of Pfizer. Pfizer makes many vaccines. Obviously, they came up with the COVID vaccine that was pretty important for all of us. But a big company. And associated with that, they make some major capital expenditures on property, plant, and equipment. And certainly right now, we're seeing a lot of investments in data centers for AI, and these are sometimes hundreds of billions of dollars. So capital investment applies broadly to a number of large expenditures, including purchasing plant equipment, developing new product lines, or acquiring companies. Capital probably just mostly means big, but I usually think of them as property, plant, and equipment or other companies, right? And so this is capital budgeting. Capital budgeting is the process of prioritizing one versus another. Which one should we do? We can't do them all because of incomplete resources, so we have to make some choices on what we're going to do. There are a number of non-financial factors that need to be considered as well, not just the dollar payoff, the percent return, but we might do a pollution control system to burnish our corporate image and deal with environmental concerns. And that might be the best investment, or new factory lighting to help our employees, or a health club or childcare facility. These things that are important that may or may not pay off directly financially, or at least not very quick, but certainly make sense from that perspective. So to illustrate, we're going to talk about the Maine Lobstars, a minor league baseball team, and they decide, or are trying to decide, whether to purchase vending machines or purchase a new bus. Okay, so the one might make more sense to make money, and the second one might make sense to have a better situation with their employees or players, essentially. So let's look at this illustration here. The Star Stadium currently has no concession stand. Steve Wilson, the team's owner, has received several bids. There's a low bid for $150,000 for a cement block to include this information. Unfortunately, the most that the struggling organization is willing to invest is $75,000. So does that make sense or not? And so Wilson receives an alternate proposal that would allow them to get 10 vending machines. So they can't deal with $150,000, but if they could put up these vending machines, perhaps they could still get a decent return. And Vendicorp would be responsible for keeping them stocked. At the end of the 5-year period, Vendicorp will repurchase machines for $5,000 and provide the Stars with an insurance and maintenance contract. And so the question is, does that make sense? Is that something they want to do? Estimates suggest that the 10 machines will take in $1,875 per ball game. If they paid 45 home games, that would make $84,375, of which $50,625 would be the cost of goods sold. And so, and it doesn't look like they're on the line for items that don't sell, only required to reimburse Vendicorp for the ones that do. So as we look at that analysis, we're seeing an incremental increase in revenue. This is good from the incremental decisions chapter a few chapters ago, but essentially seeing we're going to have an increase in annual revenue. It's going to have a cost that will then give us an increase in annual gross profit of $33,750. We've got some maintenance, we've got some depreciation we're going to have to deal with. Also going to have some increased utilities and other costs that will lead to pre-tax income of $16,400, and after tax that would be $10,000. Okay, so we're looking at that analysis. So we look at the accounting cycle and we note that we want to know what the cash flows are pertaining to any investment. And so we're going to calculate these net cash flows and use that to evaluate this investment. Okay, so as we look at these vending machines, we see the annual net cash flows is expected to be $24,000 from the investment. That was the $10,000 plus the $14,000 annual depreciation expense. Essentially, we're adding that back because that's non-cash. Okay, so we're going to look and see what the payback period is. Okay, so the investment was $75,000. The estimated annual net cash flows is $24,000, and suggests that it will pay off within 3.125 years. If we're getting $24,000 a year, will pay off in 3.125 years. All right, some other things we need to consider. This looks desirable. It's a short payback period. It seems to pay back relatively quickly. However, the payback period should never be the only factor. We need to look at other decisions. For example, what could other investments do? How about the life of the investment, not just how quick is the payback, but also what is it over the entire life? And it also mentions the timing of future cash flows. Because of the time value of money, if we can get the cash flows earlier versus later, that's going to be worth more in terms of present value. Another computation we'd use is return on average investment. And this is expressed as annual net income from an investment expressed as a percent of the average amount invested. So when straight line depreciation is used, the carrying value of the asset decreases uniformly over the asset life. So if we started at $75,000, but then looked at when it went to zero, it would turn into 1/2 of the asset's original cost. And so we want to take the return over some average investment. So first year worth a lot. Investment is big, but over time it is paying back, and we're getting it through depreciation and getting it back. And so we can see that this average investment would be the original cost plus the salvage value, and then we're going to divide that by 2. So original cost was 75, salvage value is 5, divide by 2 to get the average to get 40,000. And so we can see what that looks like here, that we'd get 10,000 per year in terms of net income, and the average investment is 40,000, so a return of 25% per year. And all other things equal, 25% looks good, but it often depends on, how reliable these are, what we can get from other investments, our own cost of capital, how big is that? Is it bigger than our cost of capital? Okay, so these methods have some problems with them. Return on investment and payback have a couple problems, including the timing of the future cash flows. When are they going to get them? If the cash flows don't arrive until late, that's going to be worth more than if the cash flows arrive next year or immediately, very soon. And so we need to look and we need to discount these future cash flows. Now, you've likely had a class that includes an analysis of discounting future cash flows or a computation of present value. So the present value in a figure depends on how big the cash flow is, the amount, the timing, when does it arrive, and the interest rate used, or it's sometimes called the discount or the required rate of return, discount rate. And to do so, we're going to use some present value tables, or you'll see in the labs associated with this, we're going to use Excel rather than these tables. Excel you can use whether you remember or have access to these tables or not. But at least for now and within the chapter, we're going to talk about the present value of $1 in n periods. Okay, so if we get something in and it's 10% interest rate, 10 years from now it's going to be worth 38%, or would be discounted to 38% of the original value of that $10,000, say. Okay. The next table looks at not just one sum arriving in 10 years or 20 years or 36 years. This one says how much are we going to get each year over a period of time. This is an annuity. An annuity is an amount where we receive the same amount each year. And so we can see what that looks like. The next thing we would need to talk about is what is the discount rate. So you can see these numbers vary drastically depending on the discount rate or interest rate. And you can see this goes all the way from 30 if the discount rate is 1% to 5 if the discount rate is 20. So going to make a huge difference. So the question is, what discount rate should we use? And so the discount rate, sometimes called the required rate of return, and this is the present value of an investment's future cash flows, is the maximum amount that an investor should be willing to pay for the investment and still expect to get the required rate of return. Okay, so this is the rate we expect to get. We want to get an expected rate of return that exceeds the rate of return required by the investor. And different investors are going to use different rates of discount. Sometimes it depends on what these funds cost. If we went and got a loan from a bank, would it be a really high interest rate? Well, then we would expect a high rate of return. And we're hoping to exceed this, that the benefits exceed the costs. And so using an illustration here, let's assume that the STARS requires a 15% annual rate of return. So that's their discount rate, or their required rate of return is 15%. So if we went and got 10 vending machines and they're expected to generate $24,000 for 5 years, that is $24,000 each year for 5 years. So that's an annuity. Now we're going to go back to our present value of an annuity, and we're going to remember 15% for 5 years. And we're going to see if we find a factor of 3.352. So let's look here, and we're going to look at 15% for 5 years, and we can see this 3.352 included here. And so we're going to multiply that by the 24,000, and that's going to help us determine the present value of the return. And so we're going to take the 3.352, multiply by 24,000, and we're going to say the present value of the cash inflows is $80,448. Okay, so we can see that. And what does this look like on a timeline? Hey, we have the present value. We note the initial cash flow is $75,000, and then we're going to get $24,000 per year for the next 5 years. And we're going to discount that at 5 years. We're going to get a present value, and that's going to be the $80,448 less the $75,000 to give us a net present value of $24,885. Okay. If we were going to look at these not discounted, we take the $120,000 and note that they're going to be discounted back to $80,448, and then we're going to compare that to what it costs and get the present value. Okay, this is another way of looking at that. Here's that $80,448. And now we're going to go a little bit further and say, hey, we're going to get $5,000 at the end. Okay, so not just the $24,000 per year multiplied by 3.352, but we're going to get the $5,000 back after 5 years. So let's go back and look at this table, and we're going to look at 15% 5 years. And so we're going to go back and look at this table. So here's the table, 15% 5 years, 0.497. So let's go and look at this again and see, hey, we multiply that 5,000 times 0.497. So the value today of that cash flow that's coming in 5 years would be $2,485. And so our total present value of the cash inflows would be $82,933. And the present value, or the cost, the original cost, as of today would be $75,000. So we'd have a positive net present value of $7,933. Okay, so we're going to use that. That incorporates the time value of money. So the net present value is the difference between the total present value of the cash inflows and the initial cost outflow. And so if it's positive, then we're expected to make more or have a greater return than our required rate. If it's negative, we're making less, and so we got to include that. So let's talk accept or reject. Okay, if the net present value is greater than 0, then the return exceeds the discount rate. Or if it's exactly 0, then the return is equal. In both those situations, we would accept, unless we have other investments that do even better or have a larger net present value. And so sometimes we got to compare that. But if the net present value is less than 0, then we're going to reject that. Okay, so there's some non-financial issues to consider. Will Vendicorp honor its agreement to stock the machines with fresh merchandise before each game? Okay, if they're sitting there and they've been there all season, well, is anyone going to want to buy them? So can we rely on them? Have we gone to other suppliers of vending machines and gotten bids from them? Does that make sense? Have we considered an arrangement with outside catering service to provide concessions at the Stars home games? Maybe get someone else to do it, or see if Vendicorp wants to do it. Finally, an unrelated investment opportunity to invest in a new pitching machine or team uniforms or new stadium seats. These are unrelated, but these might pay off even better or might make more sense from a non-financial point of view. It might make us a better team. A better team means more people come. And so let's take a look at this. You are attending your first meeting with management for Maine Lobstars. Your job is to discuss planned capital budgeting projects. With the owner, Steve Wilson is accustomed to looking at payback period and return on average investments. However, we have prepared net present value information that considers the timing and the risk, the discount rate, and the amount over these numbers of years. And so Steve Wilson argues not needed, and they should generally work in tandem with each other. It's another way to look at the same problem. Okay, so let's go to the next one. Many capital investments involve possible replacement of existing assets. Okay, so we need to make sure we're including relevant information, incremental analysis, where we're only looking at relevant costs. We're discounting future cash flows. That's what we did with the present value analysis. Some income tax effects and some non-financial factors that we always need to do. Okay, so this might not be net new investments, but we have to replace it. Okay, and so we have to see what those returns would be. So here's an illustration. We own an old bus. The old bus guzzles gas, requires lots of repairs, has no air conditioning, not working very well. And the cost of the bus is $65,000. The existing bus we could sell for $25,000, okay, potentially. The current sales value of the existing bus, okay, this would be what it shows up on our books to be, because we took the initial cost and had accumulated depreciation. But when it comes right down to get someone to buy it, we can only get $10,000 for it. Okay, estimated annual cost. Well, the new bus would be cheaper, $18,000. The existing bus would be $30,000. Okay, and so we're paying an additional amount each year. Okay, so let's go to the next slide here. Note that the old bus has a book value of 25, but a current sales value of 10, so we're going to have a loss on disposal. But the cost of the old bus is a sunk cost. It's really not relevant here, the original cost. But what is relevant is that we could sell it for $10,000 because we don't need both the old bus and the new bus. So to compute the incremental annual cash flows from acquiring the new bus, we've got to figure out the annual savings. We've got to figure out the difference in taxes. The new bus is expected to produce $12,000 annual savings. Why is that? We'll go back a couple slides here, and instead of spending $30,000 on operating costs, we're only going to have to spend $18,000 annually. So we're saving $12,000. However, annual depreciation on the new bus will be higher than depreciation on the old bus, and so we can see this difference of $8,000. And that $8,000 increase in depreciation expense means that purchasing the new bus will increase taxable income by $4,000 per year. That's the $12,000 annual cost less the $8,000 additional depreciation expense. Okay, so maybe those returns aren't quite as good as we had anticipated. So let's see. Assuming a tax rate of 40%, purchase the new bus will increase annual income tax expense by $1,600. Thus, the incremental annual net cash flows from purchasing the bus would be $10,400. Okay, so we saved $12,000, but the difference in taxes was $1,600 in additional taxes. So in that way, the depreciation doesn't really matter because we're looking at net cash flows, except the depreciation will change our annual tax expense. So we can see what that looks like. Okay, then what we can see is this amount each year, $10,400 each year for 5 years. All right, so how do we calculate that? Well, so what we see is the present value of incremental annual cash flows of $34,861, and that comes from the last slide here and says, okay, those would be $34,861. That's these 5 cash flows added up. So that's the first part. We also get to sell the old bus for $10,000. We're also going to have some tax savings because we had a loss on the disposal of the old bus. And so that's going to represent, hey, it's a loss, that's tax savings. So the total present value would be $50,000 and the cost of the new bus would be $65,000. So the net present value is negative. Doesn't make sense. Okay? At least from a financial perspective, the net present value does not return 15%. So assume you manage transportation for Lobstars. You've just seen the proposal. You know the operating cost for the new bus will not be $18,000 per year, but will more likely be $8,000, $12,000, $20,000, $24,000, and $26,000 for years 1 through 5. Do you have an ethical responsibility to mention this fact, given that operating costs average $18,000 over 5 years? Well, we should always share truth. Okay? Truth should always be known. The question is kind of the time value of money says, those costs, those operating costs are going to increase, but we get the bigger savings up front. And those bigger savings up front might mean, hey, we're going to get the cash flows earlier. Okay, so we might need to recompute it. It might actually look better in that way. Okay, but the cost is still $18,000 on average. It's just that it's small at the first few years. Time value of money says take that now. Okay, but we should always compute all of this information directly. Okay, so non-financial. Should the Stars buy the new bus? Probably so. Yes, they will save about $15,000 more than a price that provides the desired 15% return. Okay. However, the team will travel in greater comfort and greater reliability for a period of 5 years. What would be the opportunity cost of missing a ball game because the old bus breaks down? Actually, $15,000 seems like a small price to pay for the non-financial benefit. Why? Well, players might like it a lot more. The air conditioning doesn't work. That to me might be worth enough, right? And so non-financial might suggest let's do that. Okay. All right. International case in point here. Capital budgeting. For example, when McDonald's invested in Brazil, it had to strategically invest in the infrastructure to make its restaurant successful. McDonald's management frequently highlights the importance of infrastructure considerations to explain why returns in emerging markets are often lower. They've got to buy likely special equipment to do that. All right, so what are some behavioral considerations? Hey, those who evaluate the outcome might be too pessimistic or too optimistic. And so we have to kind of check on that and make sure whatever they want. So if they didn't want it to happen, they're going to assume lower cash flows. If they do want it to happen, they're going to assume higher cash flows or use a lower required rate of return, right? And so we look at that. To help combat that, we have what's called a capital budget audit. So we have plans, we look at forecasts of what will happen, and we make a decision. Then we're going to come back after the fact, some years later, and see were we too optimistic or too pessimistic, and so that we're going to learn from our performance how well we've done.